Well, on behalf of INSEAD, Mexico's Alumni Association, it's a great pleasure to introduce Kamal Hassan, who's the managing partner of loyal.vc. Loyal.vc is an open-ended, globally diverse fund with investments in over 350 companies across 60 countries. I've got to say that I don't think that can be beat. So also with a network of over 900 expert advisors, Loyal provides invaluable support to INSEAD startups. Kamal's impressive 20-year career as an entrepreneurial CEO and 15 years as an angel investor inspired the creation of Loyal. So he draws upon his experiences as a global director with the Founder Institute, former INSEAD Alumni Association president, consultant at Bain & Co, and engineer at IMAX. Kamal holds an INSEAD MBA from '93 and a degree in engineering physics from Queen's University. He's well-traveled, having visited over 100 countries and speaks 5 languages. So Kamal, thank you so much for joining us today. I know that everyone here is excited to learn the secrets of venture capital and angel investing in today's environment. I think both from an investor perspective or those also who, as a startup, are seeking funding. So just before I hand over the mic to Kamal, please feel free to ask questions. Maybe save your questions to the end of Kamal's presentation. We'll leave around 10 to 15 minutes. So do feel free to ask questions at the end. So hand over to you, Kamal, and thank you so much for joining us.
Thank you very much for the invitation, Jane. Great to meet everybody. So I'll just run through a few slides here to start us off, and do feel free to leave comments in the comments in the chat as we go also. So yeah, just going to share a little bit of my experience as both an angel investor from before and as a venture investor today. I'll talk a little bit about Loyal, not very much. I mean, it's really more of an education talk. But if you have questions about anything, including what we do, happy to cover those at the end as well. Just before I kick off, because this is a talk to INSEAD alumni, it's probably worth talking a little bit about the partnership we have with INSEAD. So as Jane mentioned, we funded over 350 entrepreneurs. Over 180 of those are INSEAD alumni. So one of the things we do is we do a good job of helping mobilize funding for INSEAD entrepreneurs. And we really provide a mechanism. So we've got 120 INSEAD alumni among our over 200 investors. And this is really a chance to get the funding for the entrepreneurs and, of course, to generate returns back for the investors. As Jane mentioned, we also have over 900 advisors. Around 500 of those or so are INSEAD alumni. And they, again, we provide a mechanism to make it easy for alumni to advise other alumni, support their businesses, and we share some of our carry. We make some of the profits we make in the fund back with the advisor network. So it isn't just free volunteering. If the company succeeds, you get a piece of that success. And of course, we also support INSEAD. So yeah, that's just a little bit of background so you can sort of see a little how Loyal fits into the INSEAD ecosystem. Let me sort of tell you a little bit about myself and how I fell into this business. So I started off as an entrepreneur, and as an entrepreneur, it's very natural to take the next step into angel investing. And I started off my angel investing career very self-confident. I mean, my undergrad engineering physics, very sort of quant-based degree. I was Ford Prize winner at INSEAD. I was a Bain & Company consultant. And then I was an entrepreneur, and I made a bunch of money as an entrepreneur. So I sort of figured that a little bit of feeling that I walked on water, and I knew the statistics in the industry. And I said, well, yeah, that's the statistics for everybody else, but I'm better, I'm different, I've got so much more going for me. And over my 15 years of angel investing, I learned a lot of humility because my stats were exactly the industry stats. 7 of my investments failed out of 10. 2 of them gave me very modest returns. And I was lucky, and I believe I was lucky, that one of the investments, actually another INSEAD alumnus, a couple of INSEAD alumni, paid off very well. I got 30 times my money back from that one investment. I had to wait 14 years to get that money back, though. So I did well financially out of this, but I really started to question a little bit all the certainty people brought to angel and venture investing. So let me just sort of share a little bit of that journey with you and a little bit of the sort of the data, the things I've learned in the years since. The first thing to start off with is to say, that's a really risky, it looks like a really risky way to invest when you have a lot of investments fail. Why would anyone even do private investing? Why not just invest in the public markets where companies seem a lot safer individually to invest in? And what I'd like to sort of flag for you here is over the past couple of decades, the balance has really been shifting between public and private markets. So back couple of decades ago, if you invested in companies like Microsoft or Amazon, when they listed, you could make thousands of times past your money back again, and was really worth checking out a lot of these sort of small stocks because tech companies went public early. And sure, the VCs, the VCs who backed them, or angels who backed them, would make 100 to 1,000x their money, but there was still lots of money left on the table. Now, when you look at top companies, the Ubers, Facebooks, even Googles of this world, your chance to get those outsized returns has become very limited. Companies will, investors, basically all of the returns, the sort of the 1,000x, the 10,000x, is all being sucked up in the private markets now. And when a tech company actually lists, there's not a lot of lift left for the retail investors. So if you want to take part in the massive wealth creation, which is the tech industry, you really need to see about investing directly in companies as an angel, through a venture fund, through a growth stage PE fund, or there are some public vehicles like SPACs, which frankly have been a great investment for the promoters who get sort of guaranteed money off the top. They haven't really proven to be good investments for the retail investors. People think a lot about public companies, and we know there's lots of private companies out there. Just what people don't really know or don't think about, you see all these articles all the time which say small business is the engine of the American economy. And what we don't think about is, yeah, of course it's the engine of the economy. It creates over half of total sales come from private companies. So when you are in public companies, yes, you can be very efficient to invest in a few of the larger companies, but you're accessing only a minority of the economy. If you want to access sort of the hidden rest of the economy, that's where the private companies exist. This is, and please excuse me for not having sources on this, because this is a very preliminary information which we're just pulling together right now, which wanted to share with you, which is, if you want to think about your investments that you have as a whole in your portfolio, one simple piece of math to do is to just step back and say, where is all of human wealth? Where is all the wealth in the investment markets created? And you will see, if you pull up the data, that around 30% of all wealth is in real estate. And most people have real estate investments. We realize it's an important asset class. Then you have another 38% of all wealth, which comes from public equities, sort of public equities and public bonds. And most people access this 42% quite well. What many people don't think about is where the rest of human wealth is, about 16% in private equity, 5% in infrastructure. And then there's a series of smaller things, including cryptocurrencies, which are about 1% of human wealth. So a good balanced portfolio would have 1% of your money in cryptocurrencies. It would have 42% in equities and bonds split roughly equally, but you would also have money in real estate and money in private equity, including private equity per se, venture capital, other private investments. Now, this has been a very challenging couple of years for a couple of markets, but especially for the tech markets, and hence really the VC and angel markets. And what we've seen is we've seen revenue multiples dropping, and that really feeds back into the venture and angel market. So it's been valuations in many places, and in a US sort of a US European environment, valuations are half what they were. Now, there's many other parts of the world where the valuations were never so inflated as they were in the US. So they haven't really come down as much. And that's one of the things we see as a global investor. So yes, in the public markets, tech valuations are down a lot. It is reflected in the buy prices. It's a very good time to be buying assets in the VC angel market. Many people worry about the sort of short-term returns, and something to remember when you're investing in private companies is this is a long-term market. You're looking for companies which are going to increase by 1,000% or more over the next 7 or more years. You're not looking for investments which you can grow and flip in the next couple of years. So whatever you think about the markets in the short term, in the long term, this is something where you get paid in the long term. Whatever blips you have over the next year or two, you're not going to exit from these investments for many years to come. So it is an interesting time to look at this market. And really, look, many people make angel and venture investing complicated. We're just traders. We buy a basket of assets low. We sell a basket of assets, hopefully significantly higher than we bought them for. And that makes this a very interesting time to be in this market because you're buying low. That's what this market will do for you today. And everyone advises you buy low, sell high. That's how you make money. And then we sit here in the midst of a period when valuations are down because everyone's scared. And we intellectually know we should be buying low, but it's actually emotionally very hard to get over this, which is why this advice still works, because people don't feel comfortable buying at the time when the market's at their lowest, which is exactly when they should buy. As I mentioned, valuations are down for a whole bunch of factors, and you can include additional factors in the US, like the failure of Silicon Valley Bank. You can see venture capitalists are falling into this sort of self-reinforcing pattern where they put more money into their existing deals to help save them, and it means they're putting less money into new deals, so valuations come down. But these are all sort of factors which are causing the market to be as it is today. Let's talk a little bit now about the actual process of picking deals, what it means to be an angel and a venture investor. And I'm going to start things off here with the Bessemer Ventures anti-portfolio. I talked about learning humility when I first started investing as an angel. And Bessemer Ventures, who's the oldest venture fund in the US, have learned the same humility. If you ever, and by the way, for the entrepreneurs on the call, if you ever walk away from a VC pitch and you go, oh my God, those guys were idiots, they just really didn't get it, they didn't understand what we were all about, then I recommend going to the Bessemer Ventures anti-portfolio online because it's a lot of fun. And this lists selected companies that Bessemer said no to and why. And you can see Apple, Google, Tesla, Coinbase, Zoom, Facebook, PayPal. And by the way, their rationale was really good. I mean, they talking to Facebook, they said, hey, kid, have you never heard of Friendster? Move on, it's over. Very good advice. PayPal, it's our rookie team, it's our regulatory nightmare. Forget it. All good advice. So this, for me, is a little bit of humility of, I don't really know if we can predict the future that well, because really smart people from some of the top VCs in the world have really struggled to do that with some of the best companies that have ever existed. And let's take you back to the actual math that underlies things. This is math from venture investments, 20,000 plus data points over multiple years, everything public the authors could find in the US. And basically the way the math works is that 2/3 of venture deals fail. You cover your losses from the next 31% of the deals, which are basically average out to about a 3x. So you can see here 65% times a tiny bit, 31% at 3x. There's your money back again. And at the end of a decade of hard work, 96% of your deals all added together gave you your money back and didn't earn you a penny. So why do people do venture capital? Why do they do angel investing? Because of these home runs, the companies that give you 10, 20, 50 times your money back again. This is where all your profit comes from. You can roughly double your money here. And this all happens with 4% of your deals, 1 in 25 deals. Now remember, VCs, when they're writing a check, they all know this math. They only want to write checks into home runs. Every time a VC writes a check, they are convinced that this deal has the potential to be a home run. And they are right 4% of the time. 96% of the time, they fail. And yeah, they have some base hits and they've got some strikeouts, but it's actually a very, very interesting business that way. And this really, these two facts lead us to question this a little bit and say, what sort of an industry is angel investing, is venture investing? Is this something like cooking where you follow a predictable formula? You want an entrepreneur who's experienced in the past, has an exit, good partner, and there's sort of, you can come up with a whole formula for what you think works in this industry because you think it's very predictable. And by the way, much of business, when you work in large companies, is broadly predictable. You may not know how much your sales are going to go up or down, but you know to within 20% what your sales are going to be. But the question we have is, look, this is an outliers business. This is something where people, every deal they do, they think they're going to be a home run and they're right 4% of the time. So maybe this should be thought of a little bit more like poker. And what's poker like? Well, poker, you start off with a couple of cards. You think maybe, you can get really excited when you see your 2 aces. You can get very unexcited when you see your 7-4 offsuit. But your outcomes are not predictable. This is why people enjoy playing poker, and things become revealed over time. And you may end up with a hand which you thought was incredibly good, actually being the worst hand at the board. If you start to question yourself this way, it also causes you to think very differently about how you invest. So if you think this business is predictable, then you want to spend all your time saying no to bad deals, because of course you can look at bad deals, you can predict who the losers, who the winners are, and you can pick the best deals and put money into only the best ones because you know what the best ones are, because you know the future. If this is an unpredictable business, then you want to think very differently. You want to avoid passing on Facebook, because no matter how many other things you sort of said no to, if you end up saying no to Facebook, you are going to miss out on massive amounts of returns. And there's some interesting data here from AngelList. They basically ran through all their proprietary data from all the angel investments they've seen. And they said that they found that running the numbers, that seed stage investors, so earlier stage investors, should put money into every credible deal. And that doing so, if you index, if you fund everything, it beats 90 to 95% of investors picking deals. 90 to 95% of investors picking deals can be beaten by indexing. And if you follow this, then what you see right away is you should put smaller amounts of money into more deals. And you can see that in our philosophy, of course, with 350 investments, with 180 INSEAD alumni investments, where we are really hesitant and uncomfortable to say no to deals because we know, and we do end up saying no to deals, we have to, but we're always worrying about are we missing out on the next Facebook? Thinking about this as a minimizing false negatives business. Now, the whole point, if you go back to those numbers again, why does diversification work? I started off by saying venture capital, angel investing looks very risky because, of course, 2/3 of your deals fail and you make all your money from these mega winners. The point of massive diversification is it de-risks the asset class. If you want a diversified portfolio, you want 20 investments. We all studied at INSEAD, 20 plus, some people say 30, 50, whatever. I'll start with at least 20 investments. Well, if you want 20 home runs, and home runs only happen 4% of the time, then you need a portfolio of 500 companies. And when you fund hundreds of VC and angel deals, you de-risk the asset class. And by funding a lot of companies, you reduce the times you miss out on these very rare mega winners. If you fund hundreds of companies, you've got this, by the way, there's only a 1% chance of something that's 20x or better. There's only a 0.4% chance of something that's 50x or better in your portfolio. Now, if you fund 500 companies, your odds are pretty good that you've got a couple of these 50x's in your portfolio. So we all know this. We all know diversification works. We don't think about how venture and angel math works. We think of it as risky, as opposed to saying, of course, when you don't diversify, something's risky. Just diversify. And then when you diversify, the asset class becomes a very interesting asset class. There's some math here to back this up, by the way. We have some data from traditional VC investments. We took the data you see here. We ran a Monte Carlo simulation. We can see a pretty good match between the reported reality from Cambridge Associates, the model when you just run these returns through a Monte Carlo simulation with 10 investments. And then if we've got a pretty good match of reality versus the model here, which, by the way, tends to say that all competent VCs are roughly equal in skill. I mean, certainly, other data I've seen says the top 2 quartiles of VCs are roughly equal in skill. Bottom quartile funds are likely to persist as bottom quartile, but otherwise, we're all pretty much equally skilled. If you then start increasing the number of investments from 10 deals to 150, and this is pure math Monte Carlo simulation, you start to see a much lower risk asset class, which looks interesting compared to public markets. Now, I've quoted different numbers here. You can do 150, you can do 500, we're at 350. The point is, you want to have a couple of hundred deals to really get good returns, which are better than public markets. Something else to mention, I'll just talk about, people in venture often talk about vintages of venture deals, which is the returns depend on the year you invest in. And this is just another way of saying, as investment advice, you say, don't time the market. You could also say, if you have perfect vision, do time the market, because you can make it a lot of money that way. And I said, now's a great time to buy. Maybe it is. Maybe you can time the market right now. But more generally speaking, you can see that returns have varied an awful lot by venture funds depending on when they launched, which does show some correlation with the market. Look, if you're going to diversify, we all know you should diversify very broadly. Our fund is very broadly diversified. This is slightly older data I'm showing here, but we are pretty much 1/3 North America, 1/3 Europe, 1/3 rest of the world. Another thing, which I'm just going to do a little sidebar here and talk about diversification, and I really want to raise this as a market failing right now. In our industry as angel and venture investing, less than 3% of the dollars go to female-founded startups. Now, I have yet to meet anybody who says that they think that 3% of the talent to run startups is in women. So what this means is you have a massive market failing where women are massively underfunded. There was a similar study from, or a related study from BCG in 2018, which showed that the dollars of revenue generated per dollar of funding in companies run by a woman versus a man was 250%. And you can look at that and say, okay, well, wait, are women way better? But to me, it's a pretty obvious reflection. Of course, if you're only funding the very best women, then the women who are funded are, of course, going to outperform the men, because you're funding a lot of mediocre men and taking money away from good women who you could be funding. So You can look at this as a social justice thing to say we want to change it. You can just look at this as a market opportunity, which is invest in women because other people aren't. And you can see a lot of opportunities. And by the way, if you want to talk social justice, people have been saying, hey, the big problem here is that only 16% of VC decision makers are women. And this has been growing over time. It's been interesting that the VC dollars to female-founded startups have been flat, even though growing. So the hypothesis is that women will fund women. And I do want to pull up a little study here, which was done by Harvard. And I think it's got very deep implications for our industry, although it's a very hard one for people to be willing to adopt. What they did in this Harvard study is they took an identical business, an identical pitch, and they had that pitch voiced by male and female actors. And then they showed them pictures of the people who they said were doing the pitch. And they got audiences of men and women mixed to score them. And what they found is there was a dramatic difference on the score given to the pitch based on both the gender and the looks of the person who was presenting. And yeah, looks, okay, they came up with their own scoring method to say, is someone good looking or not as good looking? Investor gender had no noticeable effect on the scores. So to us, this says, we know that when you hear a pitch, you are judging that pitch not just by the content of the pitch, but by who is giving the pitch. And if you want to make money, then maybe you don't want to be listening to pitches. So that's something we do. And we've noticed, by the way, if you talk to a woman, she may have some reservations about telling you how amazing she is. She may be a little modest. But if you ask a woman to describe her friend, she will tell you how amazing the friend is with no reservation whatsoever. So what we do when we invest is we don't listen to pitches. We take reference calls instead. Yeah, you can look at data and then take reference calls because we find that that is a much more normalizing factor, which tends to take gender bias out of it. And by the way, anyone who the other thing to do is just fund based on the metrics, fund based on the numbers. There's been multiple funds out there who have done this, and all of us, when we fund based on performance, see in the 30 to 40% range of women in our portfolios. I'll give you just a couple of slides on Loyal because there's a whole bunch of information there. I'll just tell you a little bit about how we came to do things and how we run our fund. And I mentioned that we don't listen to pitches. We simply do reference calls. The reason we can do this and the reason we're comfortable doing this is because of our investing process. And our investing process is we do 6 new investments a month, each of whom starts with $10,000. Our view is when we write the first check, we don't know what's going on in a company. We therefore want to have a very small amount, just like a poker player. And what we do is just exactly what a professional poker player would do, which is you pay a small ante, put it on the table to see your cards and see what's going on at that table. So we do the 3 INSEAD deals every month. The 3 Founder Institute is our other source. We then every month do 2.5, 2 or 3 deals at the next stage of investing, which in our case is $200,000. What this means, though, is it means that only the top 2% of our portfolio goes on in any one month. Although over a 20-month period, 40% will move on in any one month. It's only 2%. Similarly, we do the same process here. But we're doing this process because we know the way the math works. We know that 2/3 of our deals are going to fail. And our goal is when companies fail to try to make sure we've only lost $10,000. And we are starting to see that we have if we move to these later stages, we have half as many failures and twice as many successes at these later stages just by investing small amounts, working with companies for months to years of diligence, picking only the top 2% to move on, and running with fixed amounts to keep good diversification in the portfolio. This, by the way, is the results I can show you here very quickly. Our returns on those pilots are 7%-ish. annualized each year. The returns on the follow-on investments are sort of 26-ish% for those follow-on investments. So we're run a process to generate excess returns. It's really been working well for us. So yeah, as I mentioned, what we do is to say, this is an industry of unpredictable outcomes. Let's invest that way. And as things become revealed over time, put more money into the top companies. That's how we run our business. Show you a couple of last slides here just to think about some other aspects of venture you may not have thought of. So that's a process. Why does Loyal do fixed rules? I just want to talk for a second here about cognitive biases. We as humans are born with pre-programmed rules in our head, decision shortcuts to make life livable, because without these decision shortcuts, without things pre-programmed, life would become overwhelming. So we have a lot of cognitive biases we are fighting as investors every time we write a check. There's a sunk cost bias that I've already put money in this company. I want to save my investment. Let me put more in. We all study sunk cost at INSEAD in economics, and yet it still persists because we still have these emotional attachments. There is the endowment effect where you love your deals. Your deals are better than new deals. You've got overconfidence. There's a bandwagon effect where you feel this panic. Oh my goodness, the deal is closing. I have to get in right now. So there's a series of these different biases. And the process we run has been designed to minimize these biases. We have large upward steps in investment. You're not going to invest $1 million to save a $200,000 investment. You may love all your companies, and this is the biggest challenge in follow-on investing as a VC. You want them all to succeed, but each month you can only pick 2% to move on, and so on. The last factor I want to mention here is I've spent a lot of time talking about picking investments. The big question many people say happens in VC and angel investing these days is not, can you pick the investment, but will the entrepreneur allow you to invest? There's a wonderful survey of 100 plus VCs, 100 plus entrepreneurs to say, what are the factors that matter to the entrepreneur when picking who they work with? And everyone got it right that, guess what? The thing they care about most is the relationship, liking the investor. This is something to keep in mind if you're going to do angel investing yourself. This is the number one thing entrepreneurs are looking for. Do they like you and want to work with you? So remember that. Now, everybody in the sort of the investors all thought that the second most important factor was the brand of the VC or the partner. And guess what? Founders don't care about brand. They do care very rationally around deal terms, and that was the second most factor, and most people understood this. The factor that VCs didn't understand at all, and this is a big challenge if you're going to be in an angel group, is the third most important factor for them was the speed at which the investment happened. Entrepreneurs want money on good terms quickly from someone they like. They prefer a bird in the hand to two birds in the bush, all this stuff. I mean, entrepreneurs are really simple. They want to run their business and make money and succeed with it, and you are an enabler for that. So just be very aware that if you want to make investments in the top entrepreneurs, yeah, be likable, good deal terms, move quickly. And by the way, factor number 4 here is other founder references. This is what they cared about a lot more. So remember also how you invest, your reputation really matters, because how you've treated other entrepreneurs, and we're called Loyal VC because we try to treat our entrepreneurs well so that they will be loyal. It also means they'll give us good references. And we've done a pretty good job at that so far. I have a caveat I forgot to mention today. Well, I set it aside intentionally, which is if you're going to invest your own money in a company, be aware that it is a very long time till you get that money back again. And it's also quite a long time even to see the companies fail. I told you my best deal took 14 years to exit. So when you write a direct check into a company, you are not investing for your rent, any money you're going to make today. You are investing for your kids' education, for your retirement, for the long term. Now, this is actually when we launched our fund, we have a semi-liquid fund with a price every quarter because Michael and I have been angel investors. We know the long time period you need to hold on to your money for if you're going to invest directly. And we said, what could we do in a fund which would be different? So like I said, we have a semi-liquid fund. Most VC funds, virtually every VC fund you find will be a fixed 8 to 10 year time frame with a 12-year, an extension out to 12 years, because this is the period within which most acquisitions should happen. They'll still be left with assets at the end of that period. They'll sell them off in the secondary market at 20, 30. In fact, I'm being told right now it's a 40% discount to their face value, but just be aware of that sort of length of time there. And that is why we run an open-ended fund, which I can talk about as needed. To sum up here, we talked a little bit about why being an angel. Really wanted to challenge you to think about whether this is an industry of sort of masters of the universe who can pick the future, cooks preparing a recipe, or whether this is about poker, where you don't know the future. You can make guesses as to the odds, and you can sort of invest that way to consistently make money. Talked about the importance of diversification, of ditching the pitch if you want to really diversify by gender, showed you our stage process, talked a little bit about the fact that investing can be seen as an access game, and it's more about access, who you are, building relationships, moving quickly, and talked a tiny bit about sort of open-ended funds as a way to address the long timelines to exit. Let me stop there and move to your questions. So a couple of comments, questions. Yeah, go ahead, Jane. Start us off.
Great. No, thank you so much. I love your philosophy and your model. And it was interesting you talking a bit about, the decision-making biases. And actually just this morning, before we started this session, I was in an earlier INSEAD session, does ChatGPT make biased decisions like we do? So I was just interested in your thoughts in terms of the use of AI in terms of investing and making investment decisions.
We actually have one of our portfolio companies called Fairly AI, which does audits of AI models for bias. Because yes, AI models are trained on data. And if you trained AI models to pick the best investments based on what investments VCs picked, you would end up with massive amounts of bias in there. And yes, you need to really look at the process which is being run, the data which is being used, and you start to sort of surface immediately all sorts of hidden biases we have. I mean, I've read something in the US, they assumed people from certain postal codes in the US were rejected for loans at a higher rate. And effectively it turned the AI turned racist because it had been pre-programmed based on loan approvals to reject loans from Black areas, because that's what the model did. So I think there is a lot of power. One of the things which is really interesting about machine learning is when it surfaces things that you don't expect. And sometimes the things you don't expect are those biases. Sometimes the things you don't expect are correlations. For instance, I've heard for decades from accountants that they say their clients who prepare their finances within the first 2 weeks of the month, if you get your accounts for the previous month done in the first 2 weeks, you outperform people who are late with their financial accounts. I'd be really interested to run that through a machine learning model to see if that's true, because then you end up with some very interesting things. So yes, there's a future for it. It'll help us find interesting factors we don't think about. And you're absolutely right. It needs to be watched like a hawk to avoid the bias which can build in.
Great. Thank you so much.
Jane, go ahead. Jane Summers. Yeah.
Jane SK, Jane H. Kamal, I'm working more with PE firms, so I welcome your VC comment on any oversight, any KPIs, any requirements you give to the 350 founders and company executive teams, or is it totally hands-off? Because the PEs send in a team to consult, and the portfolio companies usually hate it. What's your strategy?
Yeah, let me actually pull up. I showed you the math. I'll pull something up from a different presentation here, just to give the background first, which is we showed you the math from a sort of very slightly broken out slightly differently from VC. This is what the breakout looks like from PE. So PE is all about your returns come from these median sort of 1 to 5x businesses. This is where 66% of your returns come from, as opposed to 50% of our returns coming from the outliers. So of course, PE is an optimization business. You should be sending in teams of experts to optimize. You don't care. I mean, outliers happen, over 10x outliers happen very rarely in PE. So this is, at least from the data that I've seen, and I'd welcome sort of other feedback, but this should be run very differently. So what are we doing here? We're trying to optimize how the very best entrepreneurs perform. And what that means is you're really dealing with, I'll call them virtuosos rather than managers. Average things can be run by managers, you bring them in. So how should you manage a virtuoso? Well, everybody benefits from access to expert help. That's why we have 900 advisors. The big difference is we're not saying you must bring in these people and do exactly what they tell you. We say, here are a whole bunch of people who can help you, who can support you. You choose who you take help from and who not. You choose whether you listen to them or not, because really you are sort of, you have, people joke about it's, startups are like you jump off a cliff and you build the airplane on the way down, but your default case is failure. And when your default case is failure, the people running a business which is default fail really should be given a lot more freedom, because these are the ones who are creating something that doesn't exist in the world. So yeah, what do? We give them help, but don't control them. But of course, it's really important to give them help. Of course, it's really important to challenge them. It's really important to actually have this dynamic. I was having a good conversation with a few other great VCs, or VCs I respect, certainly, in the past month or so. And I've heard twice from other VCs, we're often asked, do we sit on boards? And our view is, we do not want to sit on a board as a partner in a venture fund, because you have a choice with somebody. You can be their confidant or you can be their boss. And the second you sit on the board, you are their boss. They won't tell you everything, because it's sort of, they're trying to manage you. Whereas our goal as a VC partner is to be that confidant that they trust, that they tell everything to. By the way, in our case, is how we make money on the follow-on investments, because they tell us everything. I mean, what we do would be called insider trading in the public markets. It's perfectly legal here because you can have an information advantage. But it is, we will find good board members, some of the advisors, to sit on the board, not us. So it really is this control versus influence.
Got it. And do you ask for quarterly financials?
Oh, in our case, we're talking to them every month, and we want to see the monthly financial data. Because if you wait to the end of a quarter, I mean, if you wait to the end of a quarter, you're late. And in our case, remember, move quickly. We have a portfolio company in Pakistan right now, which was at our last investment committee, where the revenue was growing by 20% a week. So it was growing like this, and then all of a sudden it went like this. And if you wait till the end of the quarter to get that, to find that out, you're going to be too late. Someone else will snap that deal up before you do. Yeah. Alberto.
Yeah, thank you, Kamal. I was wondering if there are industry standards of performance, and if you have preferences on industry, and especially on services, if there are differences between industry and service.
There are a lot of people of rules of thumb in the venture industry about what you should invest in, who will, of course, tell you invest in tech, scalable tech companies and not in services businesses. We don't think that way. We fund INSEAD alumni. And if an INSEAD alumna wants to say, hey, this is what I want to dedicate my life to, when there's a lot of other things I could be doing, we will give them a chance. We will listen to them. We will see what their business is all about. I mean, we have, I don't currently see, we have Daniel Hoyos on here. And Daniel Hoyos, I don't think I'm saying anything he'll mind in saying that he has a business which is a flower importing business. It's now a flower marketplace. But if you look at that business and say someone who's shipping flowers from Colombia to Europe, is that a business a VC would invest in? Well, most VCs would tell you, of course not. But we aren't sure where this will go. We don't know what could happen to Daniel's business. So we want to give that a chance and find out where it's going. It also, I mean, we do a very good job of preserving capital. I mean, our big thing is, how do you take VC investing and actually make it more predictable? And part of that is because we diversify by industry. So we don't take industry bets. The INSEAD people we fund take industry bets, and we just fund good INSEAD people who come to us. Carolina.
Yeah, hi, hello. So my question is related to kind of like the past and the trends. So when we see the trends, more and more, we are not getting kind of like those rock star deals with like thousands of times multiples. And this is the part exactly that we offset the portfolio that we've got. So the last two columns are going to be even lower in the future. So how can we kind of like adjust the 2 times return on the portfolio, for example, take into consideration that those big bets and like best deals ever are going to be kind of like not that great again?
So a couple of things. First of all, the slide I showed first about the returns from the top deals, investors in the private markets are still writing a company that starts at a 5 million valuation and goes to a $5 billion valuation. So you are seeing companies that are getting 1,000x. I guess that's 100,000% growth. I mean, so that is still happening all the time. Those companies are still out there. I then shared information about the average returns, about the industry average, which says, yes, a VC industry average, a PE industry average is going to be sort of a 2x or so. We have been outperforming the average a bit. I mean, our ROI fully, I mean, our net ROI, everything taken off it, et cetera, is a 15% annualized, which is pretty good compared to public markets. But so you have 2 choices. You can come into private equity venture capital saying, I want to get a 40%. Well, I'll talk venture capital. I know that the best. I come into venture capital, I want to get a 40% return. Well, sure, you can get a 40% return if you're willing to invest in 10 deals, and one of those 10 deals gives you 50x your money. You can get a 40% return. But if you want to predictably make money, you're going to predictably get between a 15 and 20% return or so by being massively diversified. So it really is, what do you expect? Do you want to get 40% or do you want 15 to 20%? And you want 15 to 20%, and being in something where you double your money pretty predictably over 6-7 years is actually a pretty decent thing to have. Or do you want the 40%, in which case I have yet to find a way to get 40% returns without taking massive amounts of risk. And look, my money's in this fund. I don't want to sit there and be gambling with my retirement and say at my retirement, I might make 40%, I might lose all my money. I'd rather say at my retirement, I made 15%, I'm happy. To.
Hi, thank you for the presentation. My question is, do you have, so you show an ROI of a 5 years return earlier.
Yeah.
Do you have longer period ROI, or is that the length of your firm so far?
So our fund has only existed for 5 years, yes.
Okay, that's what I thought. My other question is, for people who are interested in like investing in your fund, do we just go on the stock market and buy the sticker?
No, unfortunately, we've got to talk about regulation for a second here, which is most countries in the world, it is totally legal to go to a casino and gamble away $100,000. But it is illegal to go as a member of the public to invest in a private company because their financials aren't listed, or in a venture fund. So you have to, and it is illegal for us to advertise to the public. I mean, I can only give our data to accredited investors. Now in the US, Canada, accredited investor means income of $200,000 a year, or family income of $300,000, or net worth of $1 million. If you want to find out about our fund, it's really simple. You just send me an email to Kamal at loyal.vc if you are an accredited investor, and I can send you information back again. But I can't put that information on our website. So yeah, but if you're an INSEAD alum, you've got sort of a secret access here, because you can find out about something like this, where, I mean, honestly, this has been a big frustration for us. This is a fund designed for individual investors. It looks a lot like a venture ETF in many ways. This would be a very easy, this would be a very good thing to just put out to the public. We'd be oversubscribed. We would spend all our time investing. I wouldn't spend any time fundraising. But we can't do that. So we are stuck in an inefficient market. By the way, one request for help, very happy to have individuals come to us. And we are really looking for distribution channels. If anybody knows good wealth managers who manage between $1 to $10 billion in assets, we have room to work with about 3 or 4 wealth managers like that around the world. So if you know anyone who's a good wealth management person who might be interested in a semi-liquid, massively diversified venture fund as part of their offering to their clients, then please send them to us.
Okay, yes, we do have some connection with some Asia commercial bank that I think are like kind of actively looking in that aspect. But like on a personal side, we check all that box for the accredited investor, but we never kind of look into that venture capital, portfolio kind of thing. So
generally speaking, it's very risky, as I think I covered earlier in the talk. So if you want to do a whole bunch of venture funds, you want to do a venture fund of funds, or happy to send you information about ours. But we are a very good first fund to just start you off and get a toe in the water.
And what would be like the initial investment for someone to join?
Yeah, our initial investment is $100,000. We will take less than $100,000 if you join our advisor network. And I think there might be a couple people on here already in our advisor network, but yeah, otherwise, yeah, $100,000.
Thank you.
Welcome. There was a request here to get the slides from Antonio. So Cass, if we can make sure to follow up with Antonio to get him the slides, I'd be happy to do that. Alberto, asked about, do we have certain industry preferences? So asked that question already. So yeah, we don't have those industry preferences. It's been really funny. I mean, we were making AI investments. Our first AI investment was made in 2018 when we launched the fund. And AI was not a hot topic then. Blockchain was really exciting. Now blockchain is out of favor. We have some blockchain, we have some AI. It was actually really funny when COVID came along. I mean, not funny, obviously, but when COVID came along, we had health investments we've been doing in 2019, and we've always done both health and travel investments. At the start of COVID, travel got killed, health boomed, e-commerce boomed. We also did e-commerce. And then you move ahead to the end of the pandemic. And what happened there? Well, e-commerce started to come down and travel had this massive rebound. And that we see that in our portfolio every quarter. And when we do the pricing, is we can see different sectors moving up and down, moving up and down. And how do you preserve capital? It's by being in multiple sectors. So whichever is hot is often balanced out by others which are not, vice versa. All right, Jane, I guess over to you if you have any wrap-up comments.
Yes, so, well, thank you everybody for participating today. Some great questions, a lot of interest. Thank you so much, Kamal. I think that it's very enlightening, sort of looking, perhaps changing some of our perspectives around venture capital and looking at angel investing. So hopefully that's inspired some people to want to actually start to be angel investors, and even some of us who are looking at, we've got some startups that we would like, support. And I think it was really interesting what you commented about, number one is the chemistry. And I think just talking about a lot of people who actually have been supported by loyal.vc, I mean, they're absolutely amazed. I mean, they say such great things. So that says a lot to you, Kamal, and your team. And also thank you so much for being so willing to come and share that with us today.
Our pleasure. Thank you for the kind words.